Your backtest returned 40% last year. That single number feels like proof your strategy works. It isn't. And before we go further, know this is educational commentary, not personalized financial advice. What I want to show you is why one backtest is one lucky life, and how running your strategy 10,000 times exposes the risk that a single equity curve hides. Here's why this matters right now. Tools are cheap, data is everywhere, and it has never been easier to run a backtest, see a smooth upward line, and size up. That smooth line is exactly what fools people. It looks like destiny. In reality, it's a single draw from a deck you will never shuffle the same way again. Let's name the wrong belief directly. Most traders think a backtest answers the question, does my edge make money? What it actually answers is much narrower. Did this exact sequence of trades in this exact order on this exact history make money? Change the order of those trades and the ending can be the same, but the journey, the drawdowns, the moments you'd have quit are completely different. Start with the simplest possible case. Flip a coin. Heads you win $1.10, tails you lose $1. That's a real edge, positive expected value on every flip. Now flip it 100 times and plot your balance. You get a wandering line. Do it again and you get a completely different line. Same coin, same edge, wildly different stories. This is the core insight, so sit with it. Your backtest is one of those coin flip lines. Your strategy might have a genuine edge, but the specific path you observed, the order of the wins and losses, was random. You are looking at one life the market happened to live. You are not looking at the range of lives it could have lived. So here's the move. Take your actual list of trades from the backtest. Every win, every loss, exactly as they happened. Then shuffle the order and replay them, tracking the equity curve. Then shuffle again. Do it 10,000 times. Nothing about your edge changes. The same trades, the same returns, you're only reordering the sequence. That's Monte Carlo simulation in its plainest form. Now instead of one equity curve, you have 10,000 of them stacked on top of each other. And suddenly you're not asking, what happened? You're asking the real question, what's the range of what could have happened given my edge? That distribution is the truth your single backtest was hiding. Look at what falls out of it. Sort those 10,000 ending balances from worst to best. The median tells you a realistic expectation, not your best day. The 5th percentile tells you the bad but plausible outcome, the one that shows up one time in 20. If your backtest said plus 40%, but the 5th percentile says minus 15, you now know that great year was closer to luck than skill. But the number that saves accounts is maximum drawdown. In your one backtest, maybe the worst peak-to-trough drop was 12%. Comfortable, now run the shuffles. Because losing trades can cluster differently, the worst drawdown across 10,000 paths might be 30, even 40%. Same trades, same edge, just a crueler order. That deeper number is the drawdown you actually have to survive. And this leads to the concept nobody wants to run, risk of ruin. Ruin isn't losing everything, it's hitting the drawdown where you stop trading or your broker stops you. If 300 of your 10,000 paths breach that level, your risk of ruin is 3%. A positive expectancy strategy with a 3% chance of blowing up is not a good strategy. It's a slow-motion accident waiting for the wrong sequence. Here's the aha sentence. Your edge decides whether you make money over infinite trades. Your position size decides whether you're still trading when infinity arrives. Monte Carlo is how you see the gap between those two before the market shows it to you the expensive way. So you cut your size and rerun. Risk 0.5% per trade instead of 2. The median return drops, smaller bets, smaller wins, but watch the 5th percentile drawdown collapse and risk of ruin fall towards 0. That trade-off, the one you can now see, is the entire job. You are not maximizing the best case. You are making the worst case survivable. Now the honest limitation, because signal means telling you where the tool breaks. Reshuffling assumes your trades are independent and your edge stays stable. Markets don't cooperate. Losses cluster in regimes, correlations spike in crashes, and a strategy that worked in low volatility can quietly die in high volatility. Monte Carlo widens your view of luck. It does not rescue a broken edge or predict a regime change. Treat it as a stress test, not a crystal ball. So what does a disciplined trader actually do with this? They never size a strategy off a single equity curve. They export the trade list, reshuffle it thousands of times, and size their position so that even the 5th percentile drawdown is one they can stomach without flinching. They ask, can I survive the unlucky order, not, how good was the lucky one? And this thinking transfers far beyond trading. Any decision with a real edge and random sequencing. A business runway, a poker bankroll, even a career bet has a distribution of outcomes, not a destiny. Stop planning for the path you saw. Plan for the range you didn't. If that reframed how you look at your own backtest, subscribe. We break down risk and market structure here without the hype. Run your strategy 10,000 times. The one time it happened was never the point.